Good afternoon, everyone. Thanks so much for joining what is sure to be a very interesting conversation about both the landscape of multifamily housing and the larger real estate market in which it exists. We all know that there is a lot going on in the world of politics, in the economy, and the property market. And we're going to cover a wide range of topics that we hope will help you make the right investment decisions. I'm very excited to have our experts in the field joining me here today, and I'd like to introduce them all to you. Charlie Keels is president of Encore Multifamily. Dr. Bharat Sangani is CEO and founder of Encore Enterprises. And Danielle Hale is chief economist at Realtor.com. Welcome, everyone.
Thanks for having us.
I also want to give the audience a quick reminder that you can pose questions in the chat box on your screen at any time during our conversation, and we'll try to get to as many of those as possible. I want to jump right into it because I know we have a lot of territory to cover today. And I want to start by diving into some of those macroeconomic factors that are currently impacting multifamily investments. So I'm going to turn things first to you, Charlie. At this pivotal moment, what are some of the inflection points that are driving the current conversations among multifamily professionals like yourself?
Well, first of all, thanks for having me. And great question. Right now, we are coming off of, or really in the peak of, historic supply, or let me back up. I mean, the most supply we really had since the 1980s, especially in the high growth markets in the Sun Belt. We expect those deliveries to really be delivered throughout now through mid 2025. Then obviously the financing costs have really started escalating in 2022, which is now starting to create some opportunity. For the first time, we're seeing projects pencil that haven't penciled due to increased construction costs that really ramped up over COVID. I mean, construction costs were increasing by 20 to 30% at a point in time. We're seeing now rents we think have now flattened out, and even select submarkets we're seeing rents start to increase. So we do see some opportunities here on the horizon, but it's really submarket by submarket in some of these high growth submarkets that we're looking at.
To that point, what are some of the strategies that you're using to adapt your investment approach and to seize some of these opportunities?
So it's really bottoms up underwriting, right? I mean, we primarily invest where the jobs are at, which is in the Sun Belt, Florida, Texas, Arizona, not as much right now, but what we know these markets and these submarkets so well. We're looking for opportunities here where we think we can time deliveries whenever we're going to be the only competition in the market. And then from an acquisition standpoint, trying to really find projects that underwrite today at these compressed rental levels where we think that there's going to be some rapid rate growth here on the horizon in the future.
I'm interested, Danielle, to get your perspective from an economist's point of view. As inflation is easing and the Federal Reserve indicates that there are more interest rate cuts ahead, what positive effects do you foresee that these monetary policy changes might have on multifamily as well as the broader housing market?
Yeah, it's a great question. Everyone likes to talk about what the Fed is doing, and the rate cuts are important because they set the sort of foundation for the yield curve. But for the multifamily market and for investors, these are long-term investments. So it's really not about the Fed's rate, which is an overnight rate. It's about long-term interest rates. And those long-term rates are forward-looking. So they're about what inflation is doing, what the economic outlook is, what's happening with the jobs market. They're trying to anticipate where the Fed's going to go. So the fact that the Fed has started cutting is great. There was a lot of uncertainty over when that might happen. It creates new uncertainty about how quickly we'll get back to a more normal Fed funds rate of roughly 2% or so. But in the meanwhile, we've seen longer term rates like the 10-year Treasury return to a more typical or expected long run normal of around 4%. That does things like bring rates for other types of investment down. So as Charlie mentioned, projects that might not have penciled out before now do, thanks to the reduction in borrowing costs. Renovation projects that might not have made sense before now could potentially. And then on the demand side of things, from the household perspective, families might be thinking, do I continue renting or do I go ahead and make a purchase? The fact that interest rates are coming down means mortgage rates are coming down. So that can nudge some families in the direction of buying a home. But right now, the scales are tipped so far in favor of renting that I don't know that this nudge will be as powerful. So I do think we'll see multifamily demand remain elevated and rental demand remain elevated because the housing market is still quite challenging to get into from an affordability perspective for households.
Yeah. Doc, I think what Danielle just said makes perfect sense. And I'm wondering what investors can do now during what is obviously a bit of a transitional time.
That's a very good question. The investors should do what investors should do all the time. As I was mentioned long time ago, many times over, that investing in real estate is not for weak stomach. And nobody should absolutely try to time the market. You can adapt to the market, but you cannot time to the market. Because if you can time to the market all the time, you are God or next to God. And we know that we are none of those, right? So the best thing to figure this out is how to adapt to the market. So my recommendation at this time is people need to adapt to the market till the interest rates completely go and rest where they're supposed to rest. And just like Danielle said, is it 4% 10-year treasury? It is 2% 10-year treasury, whatever that number is, wherever that settles, that's when strategy would change. But in the meantime, and I think Charlie tried to allude that a little bit in his talk, that what is happening right now, as of today, what is happening is the institutions are back in the buying spree. And now they are going into a high concentrated market where there is a barriers to entry and where the people who have to sell, remember, there is no people who can wait. They're waiting for the interest rates to go down and the cap rate to compress and sell it at a higher price. But there are people who have owned assets and they have to sell today for various reasons. Primarily, like Danielle mentioned, is the high interest rate. They cannot afford to keep paying the high interest rates and they just have to do something. Their loan term is getting matured, etc., etc. There are a barrage of reasons why people have to sell. So the institutions are going in there in a Class A apartment space in a high barrier to entry market at a far lower than replacement cost. So if I was an investor today, this is the market I would adapt to purchasing. But investor one time should always be investor all the time. They just need to adapt to the market. There is no right or wrong time. There is no time to time the market, etc., etc.
So keeping that in mind, that right, there's no crystal ball and there's no way to know exactly. Can you sort of predict how long it might take for some of the policy changes to meaningfully impact transaction volume, investment activity, and even property valuations?
I love you. You are telling me there's no crystal ball, and then you're asking me the same question. So but be as it may, we all are in the business of trying to predict the future. In my mind, the definition of an entrepreneur is an individual who is trying to predict the future, and we may be right sometimes, maybe not right other times. But if you look at my prediction, and mind you, I'm a cardiologist and I'm giving people an advice or my knowledge about real estate, and then it's up to them now how to take this knowledge that I'm parlaying to them. And actually, I don't even give advice. I just give my experiences and let them figure that out. But if you go back to my website and if you look at my predictions in the past, about a year and a half ago, I had predicted that within 6 to 18 months, we will see the first reduction in the interest rate. And by golly, to save me It just happened in the 16th month or the 15th month. So it didn't happen in the 6th month, but it did happen in the 15th month before that time was over. So then at that point, I said the stabilization of the cap rate and reduction of the further interest rates, and to answer your question, I think the next 12 to 18 months would be the time where I think a lot of stabilization will occur in the interest rate market. Hopefully the cap rates will compress and we will see a significant change in the buyer's sentiment. And as I know you're going to ask me a few more questions in the future of the rest of the time, I will talk about the term I have coined, buyer's confidence, and how it will impact.
Good, great. Okay, well, we'll hear a little bit more about that in a little while. I think we'd be remiss not to focus a bit on debt financing, which is such an important piece of this puzzle. Charlie, I'm wondering what kinds of trends you're currently observing in debt financing options for these multifamily investments and how that lending landscape has evolved over the past 3 or so years.
Sure. Another great question. I mean, it's really two parts, right? From an acquisition strategy, most buyers are going agency financing, which is Freddie, Fannie. Typically, most people are doing a 5-year product or a 7-year product fixed with a buy down up until this recent 10-year rally. And yep, most of those are they're spreads over the 5, 7, 10-year, even 12-year, right? Which here today on October 22nd, we've seen the 10-year rally over the past 30 days by a decent amount. Prior to that, for the first time in quite a while, you were seeing buyers get positive leverage. You were seeing them being able to get a 1.25% buy down at a fixed rate of sub 5% and buy at a, depending on the product, sub-market, buy at say a 5 cap and get slight positive leverage on an interest only basis. We have not. Today, you're probably not able to get positive leverage, but it's too soon to know how the market's adapted to this run up in the 10 years since it's just happened here recently. But we're seeing with that positive leverage an influx of transactions, like Dr. Singhani said, from a lot of institutions that have been on the sidelines. Not all of them, but a lot of them are buying and are, they're showing up on the big sheets more. We think that there's Doc did a good job of bringing up some opportunities that we think there is, which kind of dovetails into this acquisition strategy. If you can buy at positive leverage, especially on some of these urban development deals at these compressed bases, because the NOIs are so compressed due to the rental supplies that we've seen over the past 3 or 4 years, you're buying at 30% below replacement cost. Even, we see some that we think are 50% below replacement cost. Now, those are anomalies. And as long as you're convicted in that sub-market, in that overall market and the jobs that are coming in, we think it's a pretty good bet. But overall, from an acquisition standpoint, I would say it's mainly Freddie and Fannie. Now, from construction financing, the bank, historically, most construction financing is done through conventional lenders, mainly regional banks for the most part. That is still problematic. It is easing up a little bit, but lenders are conservative, right? It floats. Usually it's SOFR based, which SOFR mimics the Fed's fund rate. So you're going to be, give or take 300-ish over SOFR. So pretty high rate, right? So you're looking at SOFR today is in the, 480-ish, somewhere around there, 482, I believe. So you're going to be, almost 8%, high 7% IO base. Now that is expected to decline. And then your leverage is going to be pretty low leverage because they're going to size it based on an exit debt yield from the agencies. They're going to look and they're going to put a buffer on it of, 10, 20, 30%, depending on how conservative the banks are. On top of that, one niche that we don't exclusively do this, but we've done a lot of it over the past 15 years is HUD financing. So it's HUD 221D4 financing. We've done 20 plus transactions of that through our construction to perm financing product. We just actually locked a rate on Friday for a project in Southwest Florida, and we were able to lock that fixed rate 40 years, 5.57%. So we do see some opportunity there just to mitigate that risk. You don't take any refinance risk, but it's a niche. It's a time-consuming process. A lot of people just don't want to spend the time, but we think it's just a core competency that we have, and we've really mastered over the past 15 years.
Doc, what are some of those changes that Charlie just spoke about? How are they influencing your property management and investment strategies?
So these are two very separate questions. Let's first take the property management. Anytime the cash flow goes down, the property management comes under stress, correct? Because the interest rate goes up, suddenly the same loan that you were servicing was taking far less money than you are now paying because the interest rate went up. So suddenly the cash flow starts going down. At that point, you just go back and start putting your hand in your wallet and make sure that the wallet doesn't get empty. And the best way to do that is you start cutting corners. You start spending little less money on landscaping. You start cutting down hours of the employees. If you can cut down some employees, you cut those down. You go back to your insurance carrier, which has been a total failure for everybody in the country right now because of multiple hurricanes, et cetera, et cetera. And then you go to the insurance company and beg, borrow, and say, hey, help us to reduce our cost here. And depending upon which state you are, the property taxes doesn't help either. Property taxes continue to go up, so the management doesn't have a lot of places to go. And the multifamily, out of all these different real estate sectors, do not have a lot of moving parts. So these are the few things that you can adjust on the management side to reduce the expenses, to maintain your positive cash flow if you can, because ultimately, as all of us who are joining today, as well as on the speaker panel, we all know cash is the king, and we always respect the king, right? So that's what we all do. So that's the part of the management answer to your question about the management. The question about investment strategy, how does it impact the investment strategy of what Charlie mentioned about the reduction in the interest rate? The reduction in the interest rate is a great telltale sign that things are going to get better. And that's where I always talk about the 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 coined word buyer's confidence. It's in this world, if nothing matters more in my mind, as far as real estate transactions go, is how does a buyer feel? Whenever a buyer feels great about the economy, great about the prospects of that property doing well, he will pay any amount of money that it will take to get him in that range. So buyer's confidence does start going up every time there is a reduction in the interest rate. And the more it goes down, and the more the buyer is going to feel good about it. So to answer your question, the investors are really having a lot of dry powder sitting on the sideline for such a long period of time, for the past couple of years or plus. They are really getting revved up as soon as they feel good about it. I told you one strategy about buying high barriers to entry Class A apartments in a major metropolitan area. That's what everybody's after. And as soon as that particular group is over, where the buyer is stressed to, where the seller is stressed to sell it, then the second group of list that will start is Class B assets. The Class B assets with the same scenario will come to play. And then life will go on and it will circle again. Then by that time, people like us who have been very good in projecting and predicting development cycles, we will be out with brand new, shiny Class A apartments in the next 24 to 36 months. But like Charlie mentioned, there won't be any competition to us, or very little competition to us, because everybody else has pretty much stopped developing. So that cycle will continue, and the investor will find its niches to make the money, which is what their ultimate goal is.
So, Doc, you talked a little about insurance, and we are going to talk about that later on. I see we have a bunch of questions coming in from the audience, and I know insurance is obviously top of mind to a lot of people. So just so you know, all those watching, we will get to that topic later on. But I just wanted to talk a little bit about these increased construction costs and labor shortages, which have been well documented, as well as slowing down development. Charlie, given this increased cost of construction materials and the longer construction times, how are you adapting to ensure continued development in the multifamily sector? And is it possible that this presents a bit of white space of opportunity for developers who are able to navigate it all?
Good question, and it does. We believe so. Now, as far as unpacking that question a little bit, construction costs. So obviously during COVID, I think everybody's aware of how expensive everything got, and I would say construction costs is top of mind. It's got to be historic. I mean, how quick construction costs increase on an annual basis. I mean, some markets 20 to 30% on an annual basis. We saw construction. There's just more construction than we've seen in a long time, and not enough subcontractors to do it. So purely supply and demand. Fast forward to now where we're at. Construction costs has completely leveled out. We would like it to see it come down a bit more. As a whole, if you call any general contractor or subcontractor and ask them about any conceptual construction pricing on a project that's not imminent, first of all, you're not going to get much reaction or much detail for them looking at it, but also the pricing will be essentially flat to what it's been historically. On the flip side, if you have a real project, for instance, we have a project in Southwest Florida that we're going to be starting here in the next 4 to 8 weeks. We're seeing some real construction cost decreases, anywhere from 5 to 7%. I was actually on a call this morning with that contractor. Typically, we would get about 250 sub bids, and that's in the peak of COVID or post-COVID. It was actually less than that. But now for this project, we got 400 subcontractor bids, right? So we're going through buyout now, and we expect some pretty significant buyout. We're already in the 5% range. Our goal now is to get to 7%. I think we can even get through that. Now, site work guys, you used to have to beg and plead to get site work guys to bid your project. Now we have 7 site work contractors bidding this project. On the flip side, painters, which are the last ones in, right? The site work guys and utility work guys, they're through their pipeline. Most of their work is complete. Painters, on the flip side, they still have a pretty robust pipeline for the next 12 months. So we're not seeing their costs soften as much. So we do see definitely some opportunity there if you can get some projects out of the ground. Now these subcontractors too, they're sharp too. They're asking, financing cost. They're asking to see commitments from equity, from lenders, and they're also do not want to get out to market that the market is readjusting.
So there could be some good news on the horizon for sure.
No, we do think there is. You just have to take a very hands-on approach and really take it sub by sub and really put them all against each other. When as long as they're qualified subs, it's not always about taking the lowest bidder, right? You take the lowest bidder and you probably end up with a bad development. Making sure you have the right qualified general or subcontractors pricing the project, and really pushing them and continue to push them to get the best pricing for us and our investors. But also too, another part is design, right? It's not all about, you got to make sure that you're designing a project where you're helping your general contractor and subcontractor succeed, giving them the most efficient project they can, trying to make sure you minimize the wasted space, all the in between the walls. We're looking at always the best methods, but also the most cost-effective methods, and bringing in the subcontractors during the design process, not committing to them, but bringing them in and getting their feedback right now. I mean, literally on a phone call today, I think we saved $300,000 on some site work by getting comments from 3 different site work contractors during the bidding process. So, I mean, stuff which during the peak of COVID, subcontractors were so busy, you wouldn't get that, right? So now we're seeing that, which is definitely, flowing through to the bottom line of our investors and making projects that wouldn't pencil now.
That's great news. So, Danielle, what are some of the macroeconomic factors that have, recently driven up these construction costs? Hopefully they're going down. But I'm curious to get a sense from you what led to these increasing construction costs and these labor shortages, and whether you suspect that some of these trends may continue to stabilize and impact the housing market in the next 18 months or so.
Yeah, so I do think I'm going to answer those in backwards order. So I do think we're starting to see improvement for sure, and that is certainly welcome. The big driver of this surge in costs was largely the pandemic. It really created a lot of whiplash, not just on the demand side of things, but on the supply side of things. So as people stayed home, it made it more difficult to hire workers to go in to actually produce the materials that were in demand. At the same time that falling mortgage rates and more time at home and people trying to do all kinds of things at home, working, schooling, going to the gym, all within their space, it really amped up demand for construction projects. So you had this incredible surge in demand because of this need-based for this need for more from housing, at the same time that you had interest rates dropping that created an opportunity for people to finance this additional construction. And demand was off the charts while supply really struggled to keep up. So fortunately, as we move further and further away from that period, the market has had more time to adjust. Demand has started to normalize. Supply has also started to normalize. These things take time to supply. And so when demand is behaving as expected, it makes it easier for suppliers to get goods and services to market in a more predictable way. And we see more predictable pricing changes, which is, modest increases over time. The fact that we are seeing this healing, not just in construction supplies and materials, but across the economy, I think is a good sign. It's one of the things that's helping to bring down the overall inflation rate and helping the Fed to see that it is now a good time to normalize policy. So that is certainly helping. Now, on the labor side of things, even before the pandemic, we were in a position where the unemployment rate was at long-term lows, 3.5%. So labor demand was already strong before the pandemic, which of course exacerbated that already hot market as a lot of workers just couldn't continue to be a part of the labor force and had to maybe step back for caring for family reasons or other health concerns. So we did see this disruption in the labor market as well. Fortunately, we're also past that. So we're back at an unemployment rate that's much closer to long-run normal, right above 4.1%. That is exactly what we would expect to see in an economy that is at equilibrium. And so, that suggests more balance going forward, a little more evenness in the balance of power between workers and firms looking to hire workers, which will ultimately be good for getting the economy on a sustainable path where wages are growing modestly and not contributing to inflation, and firms can find the labor that they need to get the work done.
And I think we need to talk about rents too, right? So you mentioned this current shift in supply dynamics, and I'm wondering how that has affected rental rates and occupancy levels across different markets, and how you think those current trends may evolve into next year.
Yeah, so we had these pandemic-induced shortages, but then we also had this background context of roughly a decade of underbuilding in the housing market. On the single-family side, on the multifamily side, construction really struggled to recover after the mid-2000s boom and bust that we saw. It was gradually recovering and had gotten to a place where it was much better heading into the pandemic. And then, like other areas of the economy, we saw this whiplash where we saw housing starts surge and then sort of struggle as mortgage rates began to increase. On the multifamily side in particular, construction is slowing when we look at housing starts. And that's in part because rental vacancy rates are back closer to the long run normal that we've seen, roughly in the 6 to 7% range, after having been closer to 5%, which was a historic low. So there's normalization on the multifamily or rental vacancy rate. But we still have a significant number of multifamily units that are under construction. We're down from the record that we saw just in the past year or so. And at that point, there were more multifamily units under construction than there were single family units in the mid 2000s. So really a steep record high for multifamily construction. But that really just reflects the backlog that builders experienced as a result of these pandemic changes. And as they continue to work through that backlog, it means we're not seeing as many starts, but we are seeing a still elevated rate of completion. That means more options for renters that are in the market. we're seeing somewhat different trends on the single family side of things. Completions are elevated, but the backlog was never quite as high in the single family side of the market. But taking a step back, both multifamily and single family completions are still elevated. So that's creating more options for both renters and for home buyers. I think, I talked earlier about how that's helping to keep rents relatively stable, close to, but down slightly from record highs. I think we're likely to see rents continue to hang out in that sort of stable territory at a very relatively high level, but not increasing too much until we work through some of that backlog of construction. And we expect that will happen sometime in the middle of 2025. Then that might create more opportunity for rents to increase because there's not as much multifamily pipeline behind this current bit that we're working through. So, I think construction matters, and I think it is going to be enough to meet demand in the market, but not to the point of oversupply as we might have seen in the past couple of years.
Okay, marking my calendar for mid-2025. So considering some of the supply and rental rate dynamics that Danielle just spoke about, Doc, what are some of the key indicators that you monitor to assess market saturation or to identify growth opportunities?
This has been our pet peeve for decades. And if there are 10 different reasons we look at, the first 3 are job growth, and job growth. So if I can emphasize only one thing for listeners or the watchers today is if you want to invest someplace in multifamily sometime, and regardless of which time you want to invest, always look at job growth for the next 3 to 5 years. Most of our investments are with a 5-year horizon. So we really look at a 5-year job growth. And I also coined another word or a sentence or a phrase, something called micro GDP. So we all constantly worry about macro GDP, and we always say, okay, where is the economy going and what is it going to do, and should I invest in multifamily at this time or not? Mind you, it is important. I don't want to completely take it off the table of worrying about overall macroeconomy. But what matters the most is the microeconomy. If you are going to build a multifamily, wherever all of you are sitting around today, it really wouldn't matter that much of what is happening 5,000 miles away in the northeast corner of United States or northwest corner of United States versus what is going to happen in the 5 miles around you. And that is the concept called micro GDP. So always look at what is the GDP of that particular area that you're going to build the multifamily units. And also remember that the jobs always affects GDP. So if you have a constant growth in jobs over the next 5 years, you are relatively immune from anything else that happens around you, and you probably would be safer in this investment than any other investment. So these are the things, if I was the one who was going to take advantage of this situation, these are the things I would look for.
So it's clear, right, that despite challenges, there are a lot of opportunities available for investors at the moment. And I wanted to pose a question to you, Charlie. When do you expect activity to pick up, and what factors will drive a renewed market momentum?
It's happening now. From a sales perspective, we're seeing it happen before our eyes. Whenever buyers were able to get positive leverage, right, which was approximately 30 days ago, we've seen that buy sell, the gap shrink, and there's been a lot of projects that have well-located projects that have received a lot of activity. And talking to a lot of the brokers that we know well and have sold and bought projects from over the past 20 years, we talk to brokers almost daily, and they're projects that are priced adequately and that are well located are are getting a lot of activity, especially as Doc alluded to, Class A projects, well located. Lots of the institutions that are below replacement costs, especially where, I mean, a lot of people will like buying in oversupplied markets, right? As we do. It's a strategy that we're actively chasing right now. If you really love a submarket, why wouldn't you want to buy in a submarket that has a lot of supply now, but doesn't have a lot of supply in the future? So you're buying at a compressed NOI, right? So you're almost getting it on sale, right? As long as you really believe that rent growth story. But we're seeing it happen now. And the A's for sure, even the B's, the B value add strategy is, but I would say it's mainly the 90s, late 90s vintage stuff, well located, great suburban submarkets are getting a lot of activities. The C products, not so much, right? They're not a lot of, I mean, they're still transacting, but definitely wider cap rates, not as perfect as a market. And we expect to see that. I mean, we have had, as I alluded to earlier, a rally in the 10-year here recently. So it's too soon to see what that's going to have from the buyer sentiment. But I'll tell you, the back half of 2024, the sales volume has really gone through the roof. I mean, every broker that I know is, not only are most of them busy on active listings, but their phones are ringing off the hook about brokers' opinions and values. Potential sellers that are looking at debt maturities, like Dr. Singani alluded to earlier, are now looking at, instead of possibly refinancing, do we sell? But again, it's really asset by asset, submarket by submarket, and then market by market, right?
So we have so many audience questions. I want to get to some of them. So I'm going to ask you, Charlie, I think this question was posed from an audience member named Bob. This is a little bit tricky, I know, to say 100%, but what state, and we could sort of broaden that to territory, is most favorable to multifamily investors?
Sure. Yeah, it is a difficult question. We don't ever look at states, first of all, right? Because Doc mentioned, we're really not only looking at major markets. So first of all, we invest in the primary markets in the Sun Belt is our typical strategy. It's not exclusive because we do see opportunities in other markets. Right now, we've looked at some deals in the Pac West, but from an acquisition standpoint, wasn't able to. Those transactions weren't able to work out. But as a whole, the Sun Belt, we think. And then overall, if you're asking for where I think the best opportunities are, it's probably in Florida, but it's not Florida as a whole of the state, because there's some markets, frankly, we don't like in Florida. For instance, I'll tell you, I don't like the Jacksonville market right now. I think it's too oversupplied. I love Central Florida. I love Orlando. I love Tampa, and I love Southwest Florida. We stay away from Southeast Florida for the most part, definitely Dade County. It's a whole different animal down there. So primarily, the demand has been steady. We have not seen the rents compress as much in some of the other markets that we're in, and the supply is definitely robust, right? But it's not the supply that we've seen. So what we look at, another metric we'll look at is obviously we look at the demand, but we look at a supply demand metric. So we look at a ratio when you combine the two together. And actually, most of those markets, in some markets, we're seeing better ratios there than we're seeing in some of the Texas markets. But we're still big believers in Texas, right? I mean, Texas is our home base. Dallas, Fort Worth, San Antonio, Austin, and Houston. We're actively looking in these markets as well. It's just, big markets, right? I mean, DFW is 8 million MSA, so you really got to be an expert in these markets and really find the submarkets you want to invest in. But and then Arizona, we love Arizona now. We think Arizona is a little too early right now. Arizona got from an overall percentage, the demand stayed great, right? But some of those markets got so much supply that we think it's going to be a little bit longer to get through the supply in Arizona. But you don't want to wait to the very end, right? But we're monitoring the market. We have a lease up right now in East Valley, Phoenix and Chandler. It's actually going pretty good. We're averaging about 6 leases a week. It's a small 208 unit project, so we always would like it to do a little bit better, but that's steady at some pretty robust rents. Right now we're getting in the 230s a foot net rent. So overall, but as a whole, most of those Sunbelt markets are going to be good, but you have to really dig into those, to not only those in those primary markets, but those sub markets, and really find those pockets that you think are going to set you up for the best results long term.
So really do your research as much as possible. So I think you talked about Florida, Charlie, and I think there's two questions from Carl that I am going to sort of try to combine a little bit. First off, obviously there have been horrible storms this season. What storm hardening and hurricane damage prevention are you doing in your ground up projects? And then the second side of that question is, how are you pricing in insurance costs for those Florida projects?
Sure. So the first part of the question, so it depends where we're at. Southwest Florida, we build all concrete blocks. There's not any wood on the projects, right? Mm-hmm. So, and I'll tell you, of all of our new build constructions, we've never even had a hurricane insurance claim. I mean, we have two projects under construction right now in Florida. It looks like our damage combined with the two of total asset value between those two, roughly 140 million, is going to be about $10,000. So, I mean, the means and methods that you build now unless you get hit dead on, storm surge, something along those lines, typically we're building a little bit inland, even in Fort Myers, which is closer to the water in Orlando. But the means and methods that you're required to build in these jurisdictions, even wood frame product in Orlando, they just can sustain a ton of damage, right? As long as it's done, the construction's done correctly, which we have so many belts and suspenders internally at Encore. I mean, the guy that heads up our construction division was literally Encore employee number one, right? And he is out there making sure that everything is done correctly so we can withstand these hurricanes. I mean, and it's not only this. I mean, our projects in Houston, we literally had an eye wall go over one of our projects in West Houston in the Katy submarket. I thought there was going to be some pretty big devastation. Didn't even file an insurance claim. You know, it was less than $20,000-$30,000 worth of damage. At that point, it was a tropical storm. But now, as far as insurance costs, for the first time this renewal, we saw insurance flat to even slightly declining, but let's just call it flat, right? Now, that was before this barrage of hurricanes, right? So it is too soon to see what the impact that's going to have. But we have seen the insurance market, I would say, stabilize. But I don't know what this impact is going to have. Obviously, you get into some of the desert states, Vegas and Arizona. I mean, insurance is fairly inexpensive. Down in Florida, how you have to be experts in that field, which we have become, and you have to make sure that you're bifurcating policies. I mean, getting separate flood policies, wind policies, working through deductibles, doing deductible buy downs. It's not as simple as just going to get an all-encompassing insurance policy. That's just not how it works these days, especially in Florida. And our CFO does a tremendous job of really navigating that and that process and make sure we have the best outcome.
Faisal asks a question for Doc, which is, what are some of the right steps to take to evaluate multifamily investing firms out there? How do you check the credibility, and what parameters should people be looking for?
I don't know how she exactly found out the spot that I love to talk about. I've given several talks in the past about this situation. And to back up a little bit, investment should not be a part-time hobby. And if anybody thinks real estate is a fun thing to do to make money, either you are an absolute genius and then you can do anything. Or if you are like me, most likely you will end up with higher chances of failure than success. So be very careful to take this as a part-time job and try to accomplish something out of it. But the question is slightly different in how to evaluate all these funds, et cetera, out there who all are calling themselves multifamily experts or real estate experts. The first and the foremost thing is, when you talk to these people, how quickly do they respond and how open they are. If anybody has secrets that they cannot divulge to you, I would say run as fast as you can, because there is really no need for any secrets. At Encore, we have open books. If anybody wants to see anything anytime, we regularly send reports, and that's what you want to look for. So the most important part is how transparent this individual or this group of people who are trying to sell you a product. The second most important part in my mind is to check references. Nobody should have a problem to give you 2, 3, 5 people whom you can talk to and say, hey, how was your experience with these guys? If people say, oh, it's confidential information, I cannot give you any references, this time I would say run 3 times faster. Because if you think about it, if you made money for somebody and they are happy with you, why would that person say, I'm not going to talk to anybody about your success that you got it to me, right? So don't fall for those kind of things. The third thing is, in my mind, again, is equally important or vitally important, is to look at their track record. People should be able to share their track record with you. If you come to Encore, we give you track record for the past 25 years. We'll show you every single asset that we have purchased and sold or whatever we did with it in an audited format. Because it's not a cherry picking either. It should show every single deal that we have done. So you need to go to the group who is going to sit down with you and say, this is what we have done, however long they've been in business. And this is what we have done. These are our lemons. These are our mangoes. This is how we have done great. This is how we have done bad, etc., etc. They should be transparent and it should be verifiable product. And the last piece I would truly recommend is how long they've been in business. Let me tell you, it's very easy to be a bookmaster and know everything, but it's really different in the real world. And unless you've seen a cycle or two, and I don't want to divulge my age real fast here, although it's quite obvious, but I'm telling you, you want to make sure that whosoever you're going to trust your money, they have ample experience, that they have gone through good times and bad times at least one time, preferably 2 or 3 times. I think if you do this kind of homework, I think you should be reasonably well. And as Lucy, anybody can reach out to me anytime. I have a full-fledged mentorship program that goes on. And then if you reach out to me by email, there's no cost to it. You can reach out to, and we'll figure out a way to get everybody my email address, and I'll be glad to support whatever I can via email.
Oh, excellent. We have so many questions here that I know you're definitely going to be getting some emails, so be prepared for that talk. I just want to ask one more question, because it looks like we have a bunch of audience members who are kind of asking along the same lines about renters' rights policies. It looks like there's somebody in Chicago, someone in California, somebody in Colorado. And I'm wondering if maybe, Charlie, you could speak to that. Jennifer says, I'm in Colorado, and the government recently passed draconian regulations against multifamily operators with this new eviction prevention law that almost guarantees a tenant cannot be removed. So how does this regulation impact any desire of investors to sink money into multifamily in the state?
It is very market by market, and not even market by market. I mean, what I say, state by state, it even goes down to the local municipalities, right? So historically, we have tried to stay away from markets that try to strip landlord rights, right? Like the listener was alluding to in Colorado. We are not active in Colorado. We have done plenty in Colorado over the years, so I can't speak to that specifically. One example I can think of is we own some assets in Las Vegas, in Clark County, Las Vegas, and there was some issues in the peak of COVID that did get worked out. Where it was problematic to evict tenants, to evict non-paying tenants, and I'm not talking about non-paying tenants that are late on rent 30, 45 days one time. We're here to work with people, right? But just habitually late tenants that haven't paid rent in 6 months, right? It was tough to evict them. So that's definitely something you have to diligence, right? And make sure that you have all your tools on the front end. And I'd be very hesitant, right, to invest in a market where we did not have all of our landlord rights. Most of our investments are heavily weighted in Florida, Arizona, in Texas. We don't have that, right? Even in Texas, they'd recently had passed some jurisdictions the state did where they stripped a lot of the local city power, right? So it just made it where you cannot do that. So right now they can still drag it out, but it's typically pretty quick in Texas. I mean, 2 to 4 weeks, right? Arizona is about the same, and Florida's not too far off of that. But you definitely have to dig in and do your diligence, but it varies, right? I don't have a lot of experience in the Northeast, right? We have some commercial real estate exposure up there, but not from a residential perspective.
I said that was the last question, but I just want to pose one more to Doc, because I would like Doc to sort of explain to our audience, for investors who are looking to engage and seeing these opportunities that we've been talking about, how do capital raising platforms like Ignitn Investments and firms like Encore Enterprises assist investors so that they can navigate and capitalize on this ever-evolving multifamily landscape?
Well, thanks again to bring up Ignitn Investment. We are very proud of what we do. As you probably have a little idea just by looking at me that I wasn't born here, and I came from India. I came with $10.45 in my pocket, and then here we are. We have a multi-billion-dollar firm that we are managing and running, and most of it is owned by us. So there is a soft spot for investors in our heart, and we want to take care of our investors. And Ignitn Investment does exactly like that. In the few decades we have been in business, we have never made a capital call. We have always been transparent to the investors. Investors have never lost their principal. In fact, except one deal, they've always made double-digit returns. So this is how we are helping the investors to grow their fund, whether it is retirement or living fund or whatever that they need to make money for. We are here for them, and you are looking at one of you who is sitting here and being very, very empathetic about people's needs, because I come from that background. And that has helped me understand the desires and needs. Just think about it. You never get a capital call, but you get a great return. So it's a great combination. Again, nobody knows the future. I cannot guarantee anything for the future. But as long as I'm alive and I'm working, I will try to protect those qualities for our investors.
Great. Sadly, I think that's all the time we have for today. I want to thank all the attendees for joining us today and for your excellent questions. And thanks, of course, to our panelists for treating us to really such an insightful, educational, and lively conversation. So thank you, three, for all that.
Thanks for having us.
Thanks.
We'd love to know what you thought of this event. So please be sure to fill out the survey we'll be sending you in a little bit. And you should see a notification on your screen right now. And if you have any questions at all about this event, feel free to contact us at events@mansionglobal.com. And as Doc was saying, he's willing to get emails, so feel free to email us and we can send it his way as well. For more information on Ignitn Investments, you can visit www.ignitinvestments.com. There should be some links in the chat as well. And again, thanks everyone, and have a wonderful Tuesday.